Hi, I'm Keith McCullough. I'm sitting here with Neil Peplinksi, who's the chairman and CIO of Good Harbor Financial. I wanted to get into what's been really an incredible story of development that takes Neil back from his days at Michigan Tech as an engineer. I think he'll surprise you with a lot of ways in terms of how he thinks about the business and how he's building it. So, Neil, thanks for joining me here today.
Thanks, Keith.
Just wanted to kind of dig into your history on that front. I think I teased him sufficiently, but you didn't play hockey at Michigan Tech.
I didn't play hockey at Michigan Tech, no. Actually, I can't even skate. So, but I will say, certainly my background in terms of when it comes to investment management is definitely atypical. I did go to Michigan Tech. I got a bachelor's degree in electrical engineering. From there, I went to the University of Michigan, so go blue. Got a master's degree in engineering, and then I was hired by Motorola, which ultimately brought me to Chicago. That's where our headquarters are located. Mm-hmm. As an engineer designing cellular equipment, and the financial investment management side kind of came from that point forward as I learned to try to figure out, one, how to manage my own assets, and then from there I just capitalized on some interest around me and grew a business. But
that's literally how it started. I mean, you said, hey, I think I should try to do this myself. On the financial asset management side, this wasn't, this didn't come out of nowhere.
It didn't. I mean, first of all, I'm sure if you know other engineers, we're an odd breed, and so I always, whenever I'm out on the road, I always apologize on behalf of all engineers, because one, I know for financial advisors we tend to be the worst clients, but effectively it was a case where I wanted to learn how to manage my own assets, and as an engineer with that mentality, figured, hey, I'm going to go try to figure out how to do it myself. And that went down, this is called mid-90s-ish time frame, early to mid-90s. Buy and hold was what was happening back then, and in my mind there were just a couple of risks on that approach that just didn't sit well, and so it prompted me to try to come up with a slightly different approach, and that's where everything began.
Well, it's interesting, your approach. I mean, you thought about this from an engineering perspective, and you said, okay, look, tactical is kind of the way that I need to go, but the industry's followed you, or at least you guys are leading the industry in terms of assets under management in that regard. Can you explain to people just basically what tactical means?
It's interesting when you talk about tactical, and that if we talk about buy and hold, I think everybody will agree what the definition is, but when you talk about tactical, that can be very manager specific. Yep. Broadly speaking, I would say it definitely means that you're active with your style. From our approach, it was the idea of, for our tactical core US product specifically, the idea was we wanted to be an equity-like product, but we wanted to have a flexible enough mandate to allow us to play defense if we didn't like the outlook for the equity market. So in the broadest sense, I would say tactical is generally an active approach, usually involves some sort of defense, but from that point forward, I think as far as trading frequency and what the investable universe might be, that's going to be very manager specific, and so you would ultimately have to have a conversation with them. For us, it's very broad-based. We focus on broad-based index ETFs in most of our products. The idea is that we want to try to effectively get exposure to some broad asset categories when in favorable markets, but still have that defensive play if we don't like the outlook.
Yeah, and when you say go blue, go defense, you mean you actually mean going to cash. I mean, to a degree, relative to what a lot of traditional managers would say, or even are allowed to do. Do you think that one is a competitive advantage, or two, it's just what you should do?
I think it's certainly what you should do. That's ultimately the start of it. It's proven to be a competitive advantage, certainly as of late, but the main motivation was because I think it's something you need to do. I think there's been this misconception.
It's amazing you do that. Like when you're doing it with your own money, you actually have to go to cash to preserve that, that wealth.
Well, that, I mean, kind of sounds obvious when you say it, but it is always surprising to me. Again, not having come up in the industry, many ways I call it thinking out of the box, but because you don't know where the box is. and it really means that when you're looking at your own accounts and you're coming up with your own methodology, it only seems to make sense that if you don't like equities, why own them, right? Yep. Why not take some defense? And then when you step back and say the entire industry really wasn't built that way. The industry was built to say diversification comes from just owning a bunch of different equities, and the right way to build a portfolio is to have that domestic stocks and international stocks and maybe some emerging market stocks. But then what ultimately gets overlooked is that they're all stocks, and they can have a very common risk component, and so that there might just be a time where you don't want to own stocks, and in that sense, why not be defensive?
Now, how often do you make that decision, and or how do you make the decision to go to cash?
Right, so our portfolios, some of them are opportunistic, so they might make a few trades kind of at random times. Other ones are on more set schedules. Our tactical core products tend to trade once or twice a month, a type of frequency. We are big on objective, repeatable, model-based approaches. That's really another reflection of my engineering mentality, the idea that to me, it makes an engineer very nervous when you have a set of inputs and then you get an output, and then you have the same set of inputs and you get a different output. Like, we don't deal well with that. So,
in other words, stock picking.
So that's one way to phrase it, sure. But the idea is that having that repeatability to me means having an objective process, and you'll see that pretty consistently across all of our portfolios.
Well, I think that's why we hit it off right away. I mean, I think from a process perspective, it makes a ton of sense. You guys have seen your assets ramp to what, 11 billion?
Yeah, we're about 11 billion now.
That's a huge run. And have you been able? Do you think you have been able to do that if there weren't ETFs?
I think the ETFs are definitely an attractive component, and that's making us. So we see most of our growth since 2008, and I would say we all know what happened in 2008. But when you come out of that, there's been, I think, a number of factors that suddenly the base investors just started looking for. They wanted transparency, which of course you can get through separately managed accounts. They liked the notion of ETF managed portfolios, which from what we do, if we're buying the S&P 500, it really doesn't matter if we use a ETF or a mutual index mutual fund or futures or whatever. We're just looking for that broad-based market exposure, but the market wanted ETF portfolios, so that helped. I think ETFs can be very useful, and we are using them to our advantage in some of our other portfolios where maybe some more esoteric exposure or country-specific exposure would have been a little more difficult to get even 5 years ago. So in that case, they're definitely helpful.
Mm-hmm. Now, from a performance perspective, if you're comfortable kind of talking about what you think has made you so successful, particularly in the last couple of years, do you have anything, any special sauce from Michigan that you can
so I mean, certainly since 2008, when 2008 was a defining moment for us just because people came out of that saying, this is the second time in a decade that I've seen my portfolios get hammered. And although thinking that that's unusual, right? They talk about this lost decade and how it's like some odd event when statistics will tell you that it's not that uncommon.
Right.
But in 2008, we were up slightly on a gross basis. We were down about 7 basis points net of a 2% fee in our SMA product.
Absolute, only down 7 beeps.
Yeah, so that was...
That'll do it.
That definitely helped. The follow-on year, 2009,
and
though...
you had no short exposure.
No short exposure.
Wow.
That was, there was 2008 was great in that it highlighted the value of removing equity risk from a portfolio. So for Q4 of 2008, we had no equity exposure. But it also highlighted what I believe is another key characteristic of our portfolio is that you mentioned going to cash, and we do go to cash, but we also use shorter dated treasuries. And the idea being that since treasuries serve as the world's safe haven, oftentimes if you're in the treasury market during times of equity stress, you get that short-term drop in yields that comes along with a flight to safety, and boom, you've got a capital gain.
Wow.
Look at Q4 of 2008, and that was unbelievable. I mean, 11% plus in November due simply to being in treasuries with a little bit of leverage. So.
And then you just had a bag full of cash to put to work in 2009, I assume.
2009, actually 2009 to me, so one of the main themes in a lot of our portfolios is the idea that what really drives equity prices in the short term is not necessarily company fundamentals, but more how investors are feeling about risk. We would say company fundamentals matter, but they tend to be more of a longer term phenomenon. So if you think about the language that's been made popular over the last few years, this whole risk on, risk off type of environment, 2008 was clearly a risk off environment. But interestingly, 2009 in my mind was just the other side of the same coin. And it was the environment where people started to accept risks, particularly towards the end of Q1, where the end of the world trade, so to speak, started coming off the table. So we were all fully in the equity markets again starting in April, and you ride a small mid wave and end up the year 40+%.
Wow. So you don't lose money when everybody's getting tagged and then you have a big up year.
That's definitely the objective, although I'd be cautious to say we don't always get it right. We certainly take losses. Even this year for us has been a bit of a struggle out of the blocks, but I think over a market cycle, just the concept of saying sometimes you just want to avoid risk and sometimes it's okay to have, that in alone can be valuable.
How do you think people feel now relative to where we've been? Because I feel like last year, not just because I qualitatively feel that way, but if I look at the term structure of volatility or something like that, I could see that finally you're starting to see the term structure come down, which is not exactly a good thing. It's more a sign of complacency. But like, how do you feel that your clients feel? I mean, you've actually made them money, unlike a lot of clients who haven't made anything.
Right. I mean, I think, I don't know that I would separate it by our clients versus other clients, but I think you can think about it as the investor base as a whole.
Right.
And I think you're right. It's kind of an interesting dynamic, particularly in our tactical core products. What we're really playing on is the move from pessimism to complacency.
Right.
And in that move, you can extract value, but at some point, you get the classical
Yep.
capitulation when people become too complacent. I don't think we're there yet, but obviously as the complacency grows, then naturally that the concern of a top.
Now, if that were, now, for me, tops are processes, not points. So let's just say, for argument's sake, that there is a topping process in the growth premium out there on the equity side. How quick would you be to make that downshift that you made in 2008, or will it ever be typical?
Yeah, I mean, if there's one thing that's typical about the markets is they're not usually typical. But,
Exactly.
But I would say, so just given a process, particularly in the tactical core side where we're making those 1 or 2 moves a month, I mean, it's going to take us anywhere from 2 to 4 weeks to completely exit the portfolio. But we make very large moves when we do trade. So it's not going to be this classic case where you've got 90% equity exposure and you want to take it down to 85 or take it down to 80. If we're 100% in equities, we might take half the portfolio out in a single move, or and in a couple of moves be completely out. So we can move quickly. The drawback to that, obviously, some of this is just details of our process where we are possibly going to be 2 or a few weeks late, and we're going to feel some of the sell-off when it happens. But our belief is that some of that's just unavoidable. What you really want to avoid is to try to avoid riding the entire dislocation from top to bottom. If we can just miss some of that, we can leave the portfolios in better shape for capturing gains when they come around.
Do you think everyone still thinks we're going to have that big dislocation that we didn't have last year?
You know, the markets are a lot about psychology, just like they're about anything else, right? And I think the longer time passes and the further 2008, and maybe to a lesser degree 2011, the more those get in the rearview mirror, the more complacency grows. So, it's kind of one of those things you just kind of have to live it and react to things as they happen. But at some point, we're definitely going to get another dislocation. That's for sure. And I think it tends to happen when people suspect it the least. So
yeah, when the least amount of people are positioned for it.
Right,
sure.
exactly.
Well, thanks. I appreciate you taking the time to come here to Stanford, and I guess go Bears.
Well, I'm a Lions fan, so I'll say go Lions.
That's right.
But anyway.
And I'm Canadian, so I shouldn't be talking about football anyway, by the way. We'll talk about hockey next time.
All right, perfect.
So
Thanks,
thank
Keith.
you. If you want to find Neil, you can find him at goodharborfinancial.com. And, of course, you can find me anytime on Twitter. @Keith McCullough is my Twitter handle.